Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guest today is Luke Oliver, Managing Director and Head of Index Investing Americas at DWS Investment Management. We are talking about China ETFs today. Luke, welcome and thanks for joining us.
Thank you for having me on.
So many investors have avoided China stocks and ETFs this year due to all trade war related concerns. And, for the recent economic data has not been very encouraging. And protests in Hong Kong have further discouraged investors. But China is the world's second largest economy, and it is also one of the fastest growing too. And the growth story there is about rising middle class with increasing disposable incomes and consumption, which obviously cannot be overlooked. And some experts like Bridgewater's Ray Dalio recently said that now is the time to buy into China. And he also said that not investing in China is very risky. And he's obviously looking at very longer term picture. He's not looking at the next month or the next few months. But do you agree that now is the time to buy China ETFs?
Well, we've certainly been very close to China since 2012 with the products that we brought that gave that mainland A-share exposure. So from our perspective, we've always taken the view that most investors are underweight China in their international exposure, and then within their China exposure that's underweight, they're underexposed to those mainland companies. So we encourage people to look at China constantly for some of the same reasons that you mentioned. So I see people as being underweight. I think when people think they're investing in emerging markets and they buy emerging market funds, they don't realize that they're getting less than the true market cap for China. That's for structural reasons. But those structural reasons now have shifted, and people can get exposure to mainland China. So certainly, if people are allocating to emerging markets, they should be looking at China as it's traditionally not covered to the full extent in most portfolios. But the reasons you mentioned are so important that China, it's not a if, it's a when will China be the largest economy in the world.
Right. And
the fact that China is also, you talked about the middle class growing. Its economy is becoming more self-reliant and less reliant on the outside world. So there's so many reasons why China is such a strong story. It's a huge population. It's got huge growth. Historically, it's been one of the fastest growing economies for the last 20 or so years. And you have these huge initiatives like the One Belt, One Road that has created a lot of stimulus for China. And also with what's been going on recently, you could argue there's a great value story there. And the last thing I'll say on this is the diversification benefits.
Right.
China has historically been had a very low correlation to most other asset classes, and therefore adding China to a portfolio, although China itself can be a more volatile market, it actually generally lowers risk in portfolios when used as a diversification tool. So yeah, we really we find China fascinating, and we think it's investors should be spending more time on it.
Okay, excellent points. And in fact, if you look at Alibaba's results today, it seems that China's consumers are doing very well. And as far as the stock market is concerned, the Chinese authority can still pull more monetary and fiscal levers to boost the economy in the stock market. Now, talking about the ETFs in China, many China ETFs have struggled this year, but some of them, including the ones that DWS offers, have done much better. And in fact, a couple of your A-share ETFs are up more than 20% this year, which is even better than S&P 500's gain of about 15%. And the other two that you offer have also significantly outperformed the most popular China ETF, FXI. So could you tell us why China Asia's ETFs have done significantly better than the broader China ETFs?
Well, I think one key point is that A-shares really are the purer play on the Chinese economy, in that they represent the for instance, our benchmark in ASHR is the CSI 300. So taking the 300 top stocks in Shanghai and Shenzhen, but there's over 2,000 companies listed in mainland China versus around 150 Chinese companies listed in Hong Kong. So when you're looking at the fund that you mentioned, the largest China ETF, that focuses purely on those Hong Kong listed. So you get a much smaller subset. So when we think about the overall story for China, and especially in a passive ETF wrapper, the broader, more holistic approach of the broader benchmark in the largest universe of Chinese stocks makes a lot more sense. And the other thing I'll mention is that there's been increasing interest in A shares, and if you look at the premium of is a measure of A shares versus H shares, the A shares now have been increasingly growing at the expense of those Hong Kong listed companies. So that premium is today at 32%, which is recent highs over the last couple of years. So it hasn't been at this level since back in mid 2017, and then back in 2015 when we really saw a great performance in Chinese shares. So we're seeing that creep a little higher. But one of the big stories is index inclusion. MSCI, FTSE, and others are responding to the increased access to China to add it and increase its weight in their indices to float closer towards its true market cap weighting. So that to me is not the investment reason for China. The investment reason for China, are many that we've both mentioned, but I really like this idea that there is more money flowing into Chinese A shares because the rest of the world is catching up to the fact that they have been traditionally underweight. So there's a lot of money moving into China that's obviously supportive of equities there. And so there's a few things going on, but I think the mainland Chinese markets are now open to asset managers and investors around the globe, and I think that's got something to do with the fact that stocks have been resilient there over the past year.
So you mentioned the increase of weight by MSCI and FTSE of China A shares, and you mentioned China H shares too. So before we talk about MSCI and FTSE's proposals to increase those weights, I wanted to talk a little bit about different share classes in China. So I don't think many investors are familiar with this alphabet soup of so many share classes: A shares, B shares, H shares, N shares, and then there are chips, red chips and P chips. So could you help us understand these different share classes in China?
Yes. Well, going back one step is why does it not look like the US or or Japan or the UK? And the reason is that traditionally China has been quite a restricted market, and access to capital markets has been quite limited. So that led Chinese companies to look at foreign markets to IPO and raise money. And so as a result, you got these various legal structures as Chinese companies sought different ways to access the market. So that in some cases meant listing in Hong Kong. In some cases it meant finding ways to list in Hong Kong but be domiciled out of the Cayman Islands, which is where some of these chips that you mentioned come in. And then more recently, we've seen companies like Alibaba and Baidu list in New York. So to kind of break down a few of the key areas, are the A shares are the mainland stocks actually listed in mainland China. And we've seen these increasing, and I kind of look at that as the home market that was previously somewhat restricted is now increasingly open to global markets. So the A shares are the most numerous in number, and in terms of market cap, make up a very significant portion of the market cap of Chinese companies. I think it's roughly it's in the kind of 50% range of the market cap is there. So the most significant and the ones that the shares that we look at the most from our end. Then you have the Hong Kong listings, which there are quite a few of. I mentioned earlier about 150 of them, and they are called the H for Hong Kong, listed there. And these really are are just regular stocks, but listed in different places. And so then when you look at the N shares that you mentioned, that's the New York listing. So they're traded in dollars, listed in New York, and they are Chinese companies that have listed there. And then I mentioned some of the more esoteric share classes and share types where you might have you've got some share classes that trade in different currencies on different markets or are domiciled in different places. But the three key ones that I like to kind of pay attention to are the H, N, and A. And it's the A that people have not been accessing. So these are arguably the most important share class, and yet have been completely overlooked because of structural issues in most portfolios.
Great, that was very helpful. So MSCI started adding China A shares in its emerging markets indexes in May last year. And under the current partial inclusion plan, China A shares will have a weight of 5% this year, which would be in two phases. And in the event of full inclusion, Chinese equities would actually exceed 40% of the MSCI Emerging Markets Index. So could you tell us what this inclusion of China A shares actually mean for investors?
Yeah, well, what it means is that right now, and I'm just going to use kind of very round numbers, but China is about 20%, give or take, 20 to 23% of the MSCI Emerging Markets benchmark. And that is artificially low because historically people haven't been able to get access to all Chinese stocks. So the index provider took the decision, which is a very wise decision, was to only include stocks that investors can access. And as a result, it trimmed down the Chinese universe significantly. Now that access is there, so just a brief history of access to China is there was a quota plan where asset managers were given what's called QFII to allow them access into the Chinese markets. That wasn't enough and broadly available, so that didn't work for the index providers to add more Chinese stocks. Then there was a development which was called the RQFII, which had daily liquidity in and out of China, and that was when we saw the opportunity to create an ETF. If you have daily liquidity, you've got the potential for an ETF. And that's how we were able to bring our fund to market and gave investors access to these A shares. And then more recently, Hong Kong Connect program has been put in place by China, which is connecting Hong Kong and China, the Chinese exchanges through Hong Kong, so that anybody that can access Hong Kong can access China now. And that significantly increased the amount of access. So when that happened, the index providers got a lot more comfortable with adding China. Now, they also had some concerns that China has addressed, like the fact that Chinese companies can suspend and halt trading in their company. And the argument was that if stocks are falling, a Chinese company would sometimes have a tendency to just stop trading, just to not participate in the sell-off. It doesn't mean that the value of the company isn't falling in line with the market, but they just weren't trading. And that kind of artificial halt was a big concern for liquidity and for investors. So again, they kept them out of the index until they resolved that. So a lot tighter regulation has gone into place in China now to ensure that halts and suspensions are very tightly managed and done appropriately implemented. So MSCI got very comfortable and have started now to add A shares. Now you might say, well, why not just add them to their full exposure? Well, you could. Any asset manager or a fund manager really could go and do that. However, because you have to people managing to an index might all seek to do that at the same time, the index provider has been very responsible by slowly phasing in the addition. So as you mentioned, they started with a 5% inclusion factor, so 5% of the end amount, which will be, like I mentioned, you mentioned 40%, and there's about 23 in there now. So that kind of 17% that needs to be added for A shares will be added in over time. So 5% of that has been added. They then moved that to 10%, and then they announced just recently, in fact, in August, literally has just happened, they've increased that to 15% of that total inclusion. So 15% of what they're going to add will be added over the next couple of years. And that's we're talking about tens of billions of dollars of investor money moving into A shares because of this. So they're doing it in these increments, and it's been so far it's been seamless. The Connect program that people are using to access China has never been oversubscribed, so there's always been ample liquidity for people to move in and out of China A shares. So far so good, but we can definitely expect to see, notwithstanding some very dramatic change in course, whether that with China or global markets in general, MSCI are going to keep increasing China up to that roughly 40%, and about half of that will be made up of A shares. And one point I always mention about this: 40% is a huge number,
right.
And you've also got the potential that Korea graduates out of emerging markets into developed markets, which would then leave even more space for China to dominate that emerging market. So the reason I say this is China is so absolutely important and cannot be ignored. And so I think there's potential down the road that people will have a China exposure in their portfolio and not necessarily a broad emerging market. And that's, again, why I recommend people look at these funds that give you pure play on China, because I think the future portfolio probably has China as a standalone allocation and not part of a broad EM play.
Sure. It makes a lot of sense, as you mentioned, that tens of billions of dollars would flow into these China A shares. And DWS actually offers 4 China-focused ETFs, and 3 of them are China A shares ETFs. One is a broader China ETF. So could you tell us more about these ETFs that you offer?
Yeah, well, we offer a comprehensive suite of China ETFs. The flagship is ASHR, which is the large cap Chinese mainland A share equities tracking the CSI 300 index, and that is your and as you mentioned, up over 20% this year, despite very a lot of volatility and dramatic international level conversations between the US and China. So to see how robust that economy has been, or those stocks have been through all of this, is quite impressive. So that's our flagship. That gives you that's to my mind, if you want to get exposure to China, this is the portion. This is the kind of untapped A share portion of the market that you haven't had access to before, and that's what we look at now. The second one is the small cap, which is ASHS, and again, I think that's outperformed even better this year, and gives you access to the CSI 500, so the next 500 stocks after the 300 large caps. So again, definitely plays out to the same sort of themes when people think about why they have small and mid-cap stocks versus large cap in the US. All of those same kind of themes apply here when you look at large and versus small cap. So that's another one to look at. And then we have an interesting product. We have ASHX, and what ASH? So it's ASHX, and it's not too dissimilar to our CSI 300, but the difference is it's tracking the MSCI Inclusion Index. So this allows you to have exactly the stocks that MSCI is adding to its broad benchmarks. So if either you are a manager looking to perfectly add the Chinese stocks that MSCI is adding to your portfolio, this is the vehicle to do that. If you think that there is a potential for outperformance by buying the stocks that tens of billions of dollars will flow into over the next few years, which is a fairly reasonable theory, this is exactly those stocks. So these are the stocks that are going to get inflows from the MSCI inclusion, and there's roughly 430 stocks currently in that portfolio. So it's a large cap, has a slightly larger universe than the CSI 300, and it ties in perfectly to what MSCI is doing. And then the last but not least, and in fact, this year, as you mentioned, this it hasn't performed as well, but this has been one of the best. All I can say is it's had incredible performance over the last few years. If you look at that, and what that is our ticker is CN, and for us this is just simplicity. We talked about how complicated the market structure is, and the fact that there's P chips and red chips and H shares, N shares, A shares. Most investors probably shouldn't have to figure all of that out to invest in a market. And what CN does is gives you access to all of those different share classes all wrapped in one fund. So for us, this is just China. This is, if you want China and you don't want to have to figure out what the different share classes are or when and why you have different share classes, this is just a simple China fund, but it's the only fund that gives you the market cap weight to China. And it's simplicity. We give you the Hong Kong listings. We give you the companies, the big tech companies that are listed in New York. We give you the mainland companies that are listed in China, and all of the other share classes in their correct market cap weight. So when I kind of look at this whole suite, if people are trying to get a pure play on China, CN does exactly that.
Okay, excellent.
If you are looking to get exposure specifically to A shares because you are and generally are underweight A shares, then your ASHR, it's the largest, most liquid China A share ETF on the market. And then if you want to finely tune your portfolio to be precisely in line with MSCI, we obviously have ASHX. And for those that are getting even deeper in the weeds and they want to get the A shares in a small cap wrapper, ASHS. So we really have a great toolkit.
Yes, that's an excellent suite of products, I would say. So I'm looking at the top holdings in ASHR, and most investors, when they think of Chinese stocks, they think of maybe Alibaba and Baidu and Tencent. They are not very familiar with China-focused stocks, which are the top holdings in these ETFs, like Ping, an insurance company, which is actually a Chinese insurance and banking conglomerate. Then Kuaichao Mutual Company, which is food and beverage company. China Merchant Bank, then Industrial Bank. Could you tell us a little bit about these top holdings?
Yeah, well, I mean, these funds, almost all China funds, tend to be quite heavy in financials, as you mentioned. And what's interesting about ASHR, because it is on the mainland, and it does still have an overweight to financials, but what's different about it is the fact that it's allocated to many more banks, because you don't have just the kind of mega cap banks, but you also have some regional banks in there, which are a great growth opportunity. But it's definitely fair to say that some of these names are not household names outside of China.
Right.
That said, outside of the top 2 or 3 top names in most international funds, I think people would struggle with some of those other names that are below the sort of top 4 or 5. So this is a new market, that we're getting access to, and so I think there's probably going to be a bit of a period of education as people get used to some of those companies in China and which companies are really driving performance inside China. So without going into kind of the specifics of any individual companies, it's true to say that these are companies that just have not been exposed to international investing in the past.
Right. So I wanted to switch gears a little bit and talk about DWS's ETF strategy in general. Earlier this year, DWS launched USSG, which was actually developed in collaboration with Finland's largest pension insurance company. And this is one of the most successful ETF launches of all time. It has gathered 1.3 billion in assets, and it was launched just in March this year. It is also one of the cheapest ESG ETFs with an expense ratio of just 10 basis points. And I've seen that DWS is you continue to expand your ESG suites. So are you planning to launch more ESG funds in future? Tell us a little bit about your ETF strategy.
So we've already launched a MSCI EFA, an MSCI Emerging Market, and All World ESG strategies. In addition to this MSCI USA product that you talked about, that we've been very successful in raising 1.3 billion. And I'll add that the most recent launch, in fact, was another kind of milestone for us. Was we brought to market, or the industry, in fact, we brought the S&P 500 with ESG, and we were the first people to bring that index into a US ETF. So very proud of what we're doing in the ESG space. But what you mentioned something about the price, and that is absolutely critical, because we are pricing these funds in line with core, because the clients, especially those in Europe, in fact, more so than the US at the moment. I think US is playing a little bit of catch up, but they want ESG, and ESG is resonating, but people do not want to pay more for it or give up returns for it or take more risk for it. And that is the real, that's the challenge. Mm-hmm. So we have a long history in ESG as well as socially responsible investing, and have always strived to get this into the heart of people's portfolios. So for us, pricing these like core and designing with the index providers indices that have essentially very much inline tracking error, i.e. they will do pretty much what the benchmark does. They're designed to be sector neutral, for example. Mm-hmm. So it means that people aren't taking more risk. There's the tracking to the underlying benchmark, or the original benchmark, if you like, is very low, mm-hmm. meaning performance should be somewhat in line. And we're not charging. So we're not charging. We're charging a core price. So really, this is a core benchmark with core tracking, with a core price. And really, we want people to adopt ESG. We want people to start putting their money where their intentions are, and doing that without being afraid of underperforming or being charged a lot to do it. So this is really taking away the excuses, if you like, of why not to implement ESG. The availability now is there with this USA leaders, USSG, or the S&P 500, and international markets as well. So the products are there now. Now, what you can probably expect from us in the future, and I can't get into too much detail, but you can imagine we would want to, complement this great equity offering with some fixed income as well. So I would look out for us continuing to grow what we're doing in the ESG space.
Great. Yeah, I would definitely look forward to those products. And yes, I agree with you. Investors are getting increasingly interested in ESG strategies, but they don't want to pay a lot. So low-cost products make a lot of sense. And they also want their products, their ESG ETFs and other products to look similar to the broader market, not deviate too much. So congratulations on the success of your ESG products.
Thank you very much. And it's just key for people to also note that ESG isn't just about the doing good. Mm-hmm. These are ES and G are very much. I think there's a misconception sometimes with it that this is purely about being activist or putting morals in some way into a portfolio. When in fact the ES and G are simply ways of measuring non-financial risks in companies that can have very material financial consequences if not kept in check. And so it's ESGs. We think this is going to be the future of investing. I think the future will be that ESG is standard.
Very interesting. So that's all we have time for today. Luke, thanks again for joining us.
Thank you, Mina. Thank you.
Thanks for listening. If you want to learn more about these ETFs, please visit dws.com. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.